We are at South and First Street. That's interesting because this is Southwind Village, which is one of the first communities that UMH owned. My father bought this as a small community and expanded it back in the late 1960s. Back then in Jackson Township, the population was only 17,000 people. Today, 57,000 people live in Jackson Township, New Jersey. A drone video is going to show you this community and the $1 million houses that have been built surrounding it in that time. Owning manufactured home communities, we receive the benefit of population growth and income growth, and we as the community owners receive that increased value. Hi, Sam Landy here. We have Anna Chu, our CFO. We've traveled around to do our investor presentation at many places, but now we decided to do one right from a manufactured home community. So here we are at Southwind in Jackson, and now we'll begin the investor presentation. UMH Properties is a publicly owned real estate investment trust that has been in existence since 1968. We own and operate 118 manufactured home communities consisting of 21,500 developed home sites in New York, New Jersey, Ohio, Pennsylvania, Tennessee, Indiana, Michigan, and Maryland. We have 6,700 rental homes, and we add 800 new rental homes per year for an investment of $36 million in those rental homes.
Over the past 8 years, we have grown our company over 345% with a total enterprise value now of over $1.3 billion. In 2011, our total enterprise value was only $288 million. We've grown from 40 communities with 8,900 sites in 2011 to 118 communities with 21,500 sites today.
Southwind Village is a great community to learn about manufactured housing communities. Because it's a 50-year-old community, you're going to see some 40-year-old homes and some brand new homes. These are multi-section skyline homes or brand new houses. And as we look around, those were multi-section. Here's a single section house. A single section house is about 980 square feet. And then you're looking at a metal on metal house from the 1970s, still in excellent condition. I will guarantee you that that house will sell today for more than that person paid for it in the 1970s, based on its condition and location. The landscaping at this house was done by the resident, and that's actually typical. We have very talented craftsmen who live in our communities. They could be people who work with bricks, landscaping, carpenters, and these talented people bring their talents to our community and make fantastic looking yards and beautiful homes, and this is just one example of that. 2 years ago, there was a house from the 1960s on this lot. It was metal on metal, it was older, it really didn't create eye appeal. And now look what we replaced it with and what's here today. And that's the way manufactured housing is. We can remove those old homes and replace them with new homes, so the lot and the house look better than ever, even though that is a 50-year-old lot. And now there's a 2-year-old house on that lot. The home on the cover of our investor presentation is a multi-section home with an attached garage. This is typical of more of your 55 and older type community. A house like this can retail for as much as $220,000 in our community. The 55 and older market is picking up as people again can sell their homes and have equity to buy a new house. Buyers of homes like these are predominantly cash buyers. A house like this we refer to as obtainable housing because it's obtainable by many people. On top of obtainable housing, manufactured housing is also referred to as affordable housing. That's because in our used homes and our rentals, household income can be as low as $30,000 per year. 1/3 of a person's income should cover their housing costs. At $30,000, a person could afford $10,000 per year in home payment or home rent, and that makes our product affordable to them with no common wall neighbor living above them, below them, beside them. They're on a 50 by 100 lot, 5,000 square feet with grass. Our communities can have dog parks, clubhouses, children's playgrounds, walking areas, and they get all of these amenities for as little as $700 per month. We become quality, affordable housing as well as obtainable housing in the higher end areas of our communities. Our second slide refers to forward-looking statements. It's a legal requirement, and we'll pause here for a second for everybody to read that. The third page of our investor presentation is pictures of modern manufactured homes. The benefit of doing this video investor presentations is we can show you much better views of the interior houses, exterior houses, and drone videos of our communities. UMH was formed in 1968. It's one of the oldest real estate investment trusts in the country. We own and operate manufactured home communities, leasing manufactured home sites to private residential homeowners. Our portfolio consists of 118 manufactured home communities containing approximately 21,500 developed home sites located in New Jersey, New York, Ohio, Pennsylvania, Tennessee, Indiana, Michigan, and Maryland. UMH rents homes to residents and currently has approximately 6,700 rental units. UMH anticipates adding 800 new rental homes per year with an investment of $36 million in rental homes, which will yield $7 million in gross revenue annually. With 6,400 acres in existing communities, UMH benefits from having 3,300 acres in the Marcellus and Utica Shale regions. The company also sells homes to qualified residents through its wholly owned taxable REIT subsidiary, UMH Sales and Finance, Inc. The company has sold approximately 3,900 homes since 1995. In approximately 2011, we began our rental home program, and to date we have added approximately 6,700 rental homes, and each year we become more enamored with the quality of that income stream, with the way the residents take care of those houses, with how long those houses last and what good condition they're in, and our low expenses between tenants, and the fact that on the last Sunday of each month, one resident moves out while another moves in. The rental program has been fantastic, and we find that manufactured homes in land lease communities as rental housing may be the best form of affordable housing and the best way to provide countless families with a house they can live in and afford. The benefits of affordable living are you can put food on the table, buy the clothes you need. We've had single moms talk about how they even sent their children to private school while living in a UMH rental unit. And when you look at our portfolio map, UMH has been in business 51 years, and we started in the Northeast, New Jersey, Eastern Pennsylvania, Eastern New York. Those are areas of the country where housing has always been expensive, and all of those downturns I talked about, they never negatively impacted us because where housing is so expensive, you were always able to sell houses in New Jersey, Eastern Pennsylvania, Eastern New York, and make money. And you always maintained over 90% occupancy of the community in those areas. But then some communities that we owned for years, in the Pittsburgh markets, in the Eastern Ohio markets, they suffered the consequences of closing the steel factories, the coal plants, the tire plants. And in our own communities where we were trying to do a good job as management, we saw vacancies. And what happened to us happened to the other property owners, community owners. As you're experiencing vacancies, you can't raise rents. And that results in not being able to cover your expenses. And you can't earn sales profits because people aren't buying homes. And this trend began in about 2001. And so through this area of the country, the Pennsylvania Rust Belt, the areas around Pittsburgh, Eastern Ohio, Western Ohio, Indiana, which eventually there was 22% unemployment in Elkhart, Indiana. The community owners could not do their capital improvements, could not keep up with their repair and maintenance, had vacancies, didn't replace the old homes with new. And we saw this looking at our own problems. But eventually, as we go to page 8, when we were visiting our own communities, we saw activity going on. And this comes to about 2010. And the activity we saw going on where the extended stay hotels were full. We couldn't get a hotel room for ourselves when we were going to look at our communities. And we said, what's happening? We found out that people were coming from Texas, Louisiana, Florida, and they were coming to drill for Marcellus and Utica shale gas. And we learned a lot about the Marcellus and Utica shale. We learned that first you have to drill for it. Second, you have to have the infrastructure to pipe the gas to the places it's going to be used. Third, if you do have the gas and you do have the piping, you could create cracker plants that convert the natural gas into plastics, and panda plants that convert the natural gas directly into electricity. And based on that, we decided, hey, these areas of the country are going to dramatically improve. Instead of declining populations and declining per capita income, they're going to have rising populations and rising per capita income. And we commenced acquisitions in those places. It also helped us that these were the most affordable acquisitions. 95% occupied communities trade at about a 3% cap rate. They're great values, but the upside on those communities is rather limited. What we were purchasing was communities at 7% cap rates with only 70% occupancy, giving us a lot of vacant sites to fill to improve the operating results. We had built expansions in the past. We built 160 lots in Vineland, New Jersey, 160 lots near Allentown, Pennsylvania, and we made a lot of money doing that. But we also tried to build other projects and learned the difficulty of getting the approvals to build communities. And it's so difficult that we looked at these communities with 70% occupancy, and we said those vacant sites have incredible value when the economy improves. They're lots in existence that nobody can take away from you. Those approved lots are worth as much as $20,000 a site. And the fact that they're already built with water, sewer, roads in place, ready to go, to replace them is $70,000 a site. And we were able to acquire them when you average the entire cost. Our total costs per site sometimes were as low as $23,000 per site. So we said, these are fantastic acquisitions, we're going to do them. And that's what we did. And the Marcellus and Utica shale is generating incredible economic benefits that even result in us at various times being able to sell drilling rights in a property and then receive the 18% royalties. In one particular community, we've received $190,000 for 6 months of royalties. That exceeds the revenue from the community. So we never know what's going to happen in terms of the sale of drilling rights and what those 18% royalties are going to be. But the way they grow the economy and grow the populations of these areas is a substantial benefit to the properties we've purchased in those areas. Then when we go back to page 7 for a second, we acquired communities north of Nashville before anybody else realized how good Nashville was. And we filled these communities. They've done very well. We're in Memphis, which does very well for us. Elkhart, Indiana went from 22% unemployment to less than 4% unemployment, and we're filling those communities. Michigan, it's tougher, but there's good things going on in Michigan today in terms of auto plants being built in Detroit again, and we expect those communities to continue to grow rather than decline. And Western New York has been a very tough market for us because they lose 1% of the population a year. But recently, the economy, even in Western New York, is improving, especially Elmira, where the people drive across the line to work in the drilling business in Pennsylvania, and we're experiencing increased occupancy and revenue there. So there's a look at our portfolio snapshot: 118 communities, 21,500 home sites, 8 states, portfolio occupancy 82.8%, and we'll discuss further that we continue to buy vacancies because vacancies have value, and that if we were measuring on a same-store basis for a multitude of years, that occupancy continues to increase. Average monthly site rent, $440 per month. Total rentals, $6,700, which we continue to add 800 new rentals per year. Home rentals as a percentage of sites, 31%. Home rental occupancy, 93.6%. Additional acreage to be developed, approximately 1,689 acres. Gross asset value based on equity market cap, $1.1 million. Gross real estate book value, $892.2 million, and that's based on historic book, which really is not indicative of anything other than what we paid for these properties. More indicative of value is looking at the FFO per site and setting a value based on that. Total capitalization, $1.3 billion. Page 9, portfolio capacity per state. And very important here, Pennsylvania, we have 7,342 lots at 80.7% occupancy. The average monthly rent's $458. I'm very bullish on Pennsylvania and think that our chances of filling another 734 sites or another 10% occupancy are very good. So I believe we can achieve 90% occupancy there in a few years. Ohio, same story. You have 5,905 existing sites, 80.2% occupancy, $385 average monthly rent. With a strong economy and a lot of reason to believe we can increase the occupancy to 90% over the next few years. Indiana, same story, 3,982 sites, average occupancy 82.9%, $390 average monthly lot rent, and strong chance to achieve 90% occupancy. Tennessee, you're already at 94.2% occupancy, and a significant portion of our 340 or so lots we're building this year are in Tennessee because we're already over 94.2% occupancy. New York, 1,160 lots, 84.5% occupancy, and we're seeing gains in occupancy there right now. New Jersey, as mentioned, always maintains 94.1% occupancy. Most vacancies are caused by us buying old homes, removing them to replace them with new to add to earn sales profits, and $625 average monthly lot rent. Michigan, only 75.7% occupancy, but only 354 lots. And again, we're working on filling those sites. Maryland, we have one community with only 62 lots built today, 91.9% occupancy. We have expansion lots virtually fully approved. We're waiting for permits to complete construction to build this out to its full build out, which is approximately 160 sites. Go to rental capacity per state, and these are our rental homes. And in Pennsylvania, we have 2,119 rental homes, and those homes average 91.4% occupancy at $776 average monthly lot rent. And the important thing to think about here, we purchase a 16 by 70 foot house from the factory, so over 1,000 square foot, 3-bedroom, 2-bath house. We buy it from the factory for approximately $35,000. We spend $10,000 setting it up, so we have $45,000 into it. We want to gross 20%, or a little over $8,000 per year on lot rent. And so that $776 average monthly rent does that for us. And we're doing that there in Pennsylvania. You look at Ohio, 1,808 lots, 100,800 homes, 93.8% occupancy, $684 average monthly rent. Indiana, 1,392 homes, average occupancy 95%, $748 average lot rent. Tennessee, 806 homes, 96% average occupancy, $762 average monthly rent. New York, 318 rentals, 95% average occupancy, $897 average monthly rent. Michigan, 184 rentals, 95.1% average occupancy, $755 average monthly rent. New Jersey, 38 rentals, 86.8% occupancy, $948 per month. Generally in New Jersey, we don't need to use rentals because there's such high demand for resident-owned homes, but during the real bad downturn in 2009, we did use rentals, and that's predominantly where the 38 rentals came from. And so today we have 6,665 rental units, 93.6% occupancy, $749 average monthly rent. And again, we believe that this is a great business and a great way to provide affordable housing and the equivalent of any apartment unit.
I'm Brett Taft, a Vice President with UMH Properties. Since 2010, we've acquired 90 communities containing 14,850 developed home sites for a purchase price of $444 million, or approximately $38,000 per site. Many of these were value-add communities located in markets that we believe were poised to experience economic growth. Generally, it takes 2 to 3 years to turn around a property before it starts to produce meaningful results. First, we complete the deferred maintenance and capital improvements that the prior owner was unable or unwilling to do. Next, we implement our sales, rental, and marketing program, which results in rapid infill of these locations, driving significant property-level value. This value can be realized through the financing or refinancing of these communities. Most of the physical work can be completed in under a year, but it takes time to change the reputation of a community. We are very satisfied with the results of our previous acquisitions. For example, we purchased Countryside Village in Columbia, Tennessee in 2011 for $7.3 million, or approximately $21,000 per site. We invested $9.16 million subsequent to the acquisition, resulting in total capital investment of $16.46 million. Today, this property is 95% occupied, as opposed to 55% occupied at the time of the acquisition, with 222 rentals and a site rent of $372. Another example is Holiday Village, located in Nashville, Tennessee, which was acquired in 2013 for a total purchase price of $7.25 million, or approximately $27,000 per site. Subsequent to the acquisition, we invested $7.1 million in the property for a total capital investment of $14.36 million. Today, the property is 97% occupied versus 82% occupied at the time of the acquisition, and valued at approximately $20.4 million, or $78,000 per site. One more example is Boardwalk and Park Place, located in Elkhart, Indiana, which were acquired in 2017. The purchase price on these acquisitions was $21.2 million, representing a cost of approximately $38,000 per site. Subsequent to the acquisition, we invested $4.6 million in the property for a total capital investment of $25.8 million. Today, the property is 98% occupied versus 77% occupied at the time of acquisition, and worth approximately $37.6 million, representing a value per site of approximately $67,000. Currently, we have 4 communities under contract, which contain 1,470 developed home sites with a current occupancy rate of 66%. The total purchase price for these communities is $56 million, or approximately $38,000 per site. 2 of the communities are located in the Pittsburgh, Pennsylvania market, 1 in Perrysburg, Ohio, and 1 in Erie, Michigan. All of these communities are expected to close in the next 3 months. We continue to search for properties that meet our acquisition criteria.
Our business plan has allowed us to grow rapidly, as we said before. Over the last 3 years, rental revenue increased 62%. Community NOI, it also increased 62%. Core funds from operations and normalized funds from operations nearly doubled in the last 3 years. Percentage-wise, it increased 35% in 3 years. As you turn to slide 27, you can see the growth in our total enterprise value. In 2011, we were at $288 million of gross enterprise value. And now we are at $1.3 billion. This is an increase of 345% over the past 8 years. In 2011, we had 40 communities with 8,900 developed home sites. Today, we have 118 communities with 21,500 developed home sites. But throughout this growth, we have not sacrificed our balance sheet. As you turn to slide 28, you will see that our net debt to total market capitalization is 34%. We also have a securities portfolio of $109 million, which is approximately 9.8% of our total assets. Net debt less the securities portfolio to total market capitalization is only at 26%. Net debt to adjusted EBITDA is 6.9 times, and fixed charge coverage is 1.6 times. Subsequent to quarter end, we issued $100 million of our 6.75% Series C preferred stock. This further enhanced our liquidity and strengthened our balance sheet. We will use the proceeds from this preferred stock offering for our acquisitions, as well as the purchase of our rental units and for the expansion of our communities. As you turn to page 29, you can see that we have total debt of $444 million, of which $329 million was community level, long-term fixed rate mortgages at a weighted average interest rate of 4.3%. Over the last few years, we have been refinancing our mortgages due to the protracted low interest rate environment. Over the next 2 years, 2019 and 2020, we have 4 loans maturing with an approximate balance of $14 million and a weighted average interest rate of 5.9%. We believe that we will be able to refinance these communities at lower interest rates, probably at around the 4% level, thereby further decreasing our weighted average interest rate.
I'm Eugene Landy, chairman of UMH Properties, Inc. This is a company and industry I've been in more than 50 years. UMH Properties, Inc. started with one community in Eatontown, New Jersey, and we built our first community 60 years ago in Jackson Township, New Jersey, Southwind Mobile Home Park, we called it then. I guess we call it Southwind Village today. And we built approximately 250 sites, and it cost us $10,000, and we thought we had a cost overrun. Today, the park is worth 5-10 times what it cost us to build many decades ago. Even more important, we run the community and we continue to upgrade it, and today it's as modern as any other community in our portfolio. And the beauty of manufactured housing is that when the homes get older, we take the homes out and put in brand new homes. So we've continued to upgrade and build all our communities to a high scale. And the important thing is that we run them as communities so that they're the best place in the county for people to live, and that they're the most affordable units in the county. UMH has been successful its entire career, notwithstanding the fact that we've had the 3 or 4 cycles when the economy has not been very good and when many businesses have struggled to survive. We've always operated profitably, and we've always paid dividends. We started at $1 a share, and today we're about $14 a share. And we started with a 10-cent dividend, and today our dividend is 72 cents. So the manufactured housing business has been good for our residents, and it's been good for our investors. Today we have 118 communities, and we'll continue to acquire communities. We're today the 7th largest owner of manufactured housing communities in the United States, and we plan to continue to grow.
We hope that this video of our investor presentation has demonstrated to you our long-term track record of profitability, our strong acquisition track record with a sizable current acquisition pipeline, our well-positioning for the housing market rebound, significant upside in the real estate portfolio with only 82.8% occupancy and ability to increase that occupancy, our strong balance sheet and stable credit metrics, that we're well positioned to benefit from the rapidly expanding energy sector investments being made in our region, our significant potential growth through adding rental units, our proven access to institutional capital, our compelling value relative to implied net asset value, our proven ability to add value through acquisition and expansions, and we have inside ownership of 11%. We have an experienced management team that we're proud of, and we look forward to you continuing your research into UMH properties and hope that you become investors in our company who we can meet at our annual shareholders meeting. Thank you.